The path of the speculator is paved with the ghosts of failed accounts, a testament to the brutal, unforgiving nature of the game. So many enter the arena armed with hope and a handful of tips, only to be swiftly and mercilessly separated from their capital. They fail not for a lack of intelligence or courage, but for a lack of a coherent, disciplined philosophy. They are playing a game of chance while the masters who endure are engaged in a serious, calculated business. Jesse Livermore, through a lifetime of spectacular victories and devastating defeats, codified the unwritten laws of this business. He did not leave behind a magic formula, but something far more valuable, a set of foundational golden rules that serve as the ultimate defense against the market's perils and the speculator's own worst instincts. He learned that success in speculation is not an accident. It is the result of a lifetime of study, of constant observation, and of unwavering adherence to a set of immutable principles. To violate these principles, he discovered, was to invite certain ruin. To follow them was to align oneself with the great, powerful forces that govern all market movements. These are not suggestions or guidelines. They are the commandments of speculative survival. The trader who ignores them is destined to join the silent, impoverished majority. The one who masters them is given the key to unlocking the vast potential of the market. What follows is a dissection of these golden rules, the very architecture of Livermore's legendary success. They are principles forged in the heat of battle, paid for with millions of dollars in losses, and ultimately responsible for the millions more that he won. They are as relevant today as they were a century ago, for while the stocks, the players, and the technology may change, the underlying game, governed by the unchanging forces of human greed and fear, remains eternally the same. These rules are the speculator's ultimate shield. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed, chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The first and most foundational of all Livermore's rules was to trade with the primary, underlying trend. He understood, with a clarity that eluded most of his contemporaries, that prices move along what he famously termed the line of least resistance. This was not a mystical concept, but a simple, practical observation. Prices will do whatever comes easiest. They will go up if there is less resistance to an advance than to a decline, and vice versa. The speculator's entire job, as he saw it, was to correctly identify this path and to align his operations with it. He was adamant on this point. One must not argue with the market's condition, and most of all, one must not try to combat it. To be a bull in a bear market or a bear in a bull market was not a sign of courage, but of foolishness. It was to pit one's own small, finite resources against an irresistible, impersonal force. This was a battle that could have only one outcome. The successful speculator does not fight the trend. He joins it. He is the surfer who rides the great wave, not the swimmer who tries to fight against the tide. This principle required a profound level of patience. It meant refraining from trading for long periods, waiting for the market to declare its own intentions. There are times, he insisted, when one should speculate. And just as surely there are times when one should not speculate. The wise trader is the one who knows the difference, who has the discipline to stay out of the market when the line of least resistance is not clearly defined, when prices are moving sideways in a narrow, confusing range. It is in these periods of indecision that the amateur loses his capital, chipping it away on meaningless, unprofitable trades. The second golden rule is perhaps his most famous, a piece of wisdom so essential that it should be etched into the mind of every person who ever dares to place a trade. cut your losses quickly. Livermore learned at a cost of millions that this was the single most important principle for capital preservation. He stated, with the certainty of a man who had seen the alternative, that profits always take care of themselves, but losses never do. A losing position is a problem that, if left unattended, will only grow worse. He believed that the first loss was always the best and smallest loss. It was a small, manageable price to pay for the information that your initial judgment was wrong. To hold on to that loss, to hope that it would come back, was to substitute wishful thinking for sound business practice. It was to allow a small, treatable wound to fester into a gangrenous, life-threatening infection. The speculator, he insisted, must be his own insurance broker, and the only way he can insure himself against a catastrophic loss is by taking the first small one. This rule is a direct assault on the speculator's most powerful emotional enemies, hope and ego. When a trade goes against him, the amateur hopes for a reversal. His ego, which hates to admit a mistake, convinces him to give the trade more time. Livermore knew this was a fatal combination. The professional, he believed, must act on a healthy and rational fear when he is losing. A fear that the small loss could develop into a much larger one. This fear is not a weakness. It is a catalyst for the decisive, disciplined action that ensures his survival. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, from the deep value principles of Peter Lynch, to the pioneering trend analysis of Charles Dow, and the modern psychological insights of Ed C. Cota, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. The third golden rule is the offensive counterpart to the defensive act of cutting losses. It is the principle that allows a speculator to capture the great fortune-making moves. The rule is this: let your profits run. Just as the amateur is crippled by hope when he is losing, he is crippled by fear when he is winning. He sees a small, quick profit and is seized by the fear that it will vanish. He sells too early, snatching a few points from a move that may have 100 points yet to run. He is, as Livermore said, growing rich by taking a 4-point profit in a bull market. Livermore's most profound realization, the one that elevated him from a successful plunger to a legendary speculator, was that the big money was never made in the day-to-day fluctuations. It was made by sitting tight. He recounted the story of Old Man Partridge, a wise trader who, when asked for his opinion in a roaring bull market, would simply reply, "Well, you know this is a bull market." This was not a flippant remark, it was a piece of profound wisdom. It was a reminder that in a great trend, the speculator's job is not to trade, but to hold his position, to have the courage and the patience to ride the move for all it is worth. This requires an almost superhuman level of emotional control. It is the ability to sit through the normal, healthy reactions that are a part of every major trend without being shaken out by fear. A profit, Livermore knew, was the market's own confirmation that your judgment was correct. To abandon a position for which you have such powerful validation is an act of strategic folly. The speculator must learn to be as patient with his winning trades as he is impatient with his losing ones. The fourth golden rule is a direct and forceful prohibition against the speculator's most self-destructive habit. Never average down a losing position. Livermore considered this the cardinal sin of speculation, a practice so fundamentally flawed that it was guaranteed to lead to ruin. To buy more of a stock that has already declined is to reinforce failure. It is to argue with the tape's clear verdict that your initial judgment was wrong. It is to throw good money after bad in a desperate, ego-driven attempt to prove the market wrong. He stated with the force of an unbreakable law, of all speculative blunders, there are few greater than trying to average a losing game. He knew from his own catastrophic experiences, particularly his disastrous cotton trade, that this practice transforms a small, manageable loss into an uncontrollable, account-destroying disaster. It is an act of pure hope, and hope in a losing position is a lethal poison. The professional never hopes his way out of a bad trade. He cuts his way out, preserving his capital to fight another day. The fifth golden rule provides the professional's alternative to averaging down. It is the constructive, wealth-building strategy that stands as its polar opposite. Pyramid your winners. Livermore's method was to never commit his full capital at once. He would begin with a small, exploratory position. If and only if that initial trade showed him a profit, would he add to it. He would buy his second lot at a higher price than his first and his third at a higher price than his second. He was averaging up, not down. This strategy ensures that the speculator's largest commitments are always made in trades that are already successful. He is not funding a losing battle. He is reinforcing a winning one. The market itself is financing his increased exposure through his accumulated paper profits. It is a strategy built on confirmation, not on hope. It requires the discipline to buy at prices that seem high to the amateur, but that the professional recognizes as a sign of confirmed strength. By reinforcing success and ruthlessly abandoning failure, the speculator aligns his capital with the market's primary force, the very definition of intelligent trading. The sixth golden rule in Jesse Livermore's arsenal was the cornerstone of his timing, the very mechanism that protected him from the market's most common and costly traps. He would always wait for confirmation. The amateur speculator is a creature of impatience. He is driven by a constant, anxious need to be in the market, fearing that if he is not participating at all times, he will miss the next great move. Livermore knew this hankering for activity to be a fatal flaw. He understood that the great opportunities, the high-probability trades that build fortunes, are rare and episodic. They do not appear every day, or even every week. The speculator's job is not to trade, but to wait patiently for the market to give its unequivocal signal. This signal for Livermore came at what he called the pivotal point. This was not a vague feeling or a hunch, but a specific, identifiable price level where the battle between buyers and sellers had reached a decisive conclusion. It was the moment a stock was ready to move, the point at which the line of least resistance was clearly established. To enter the market before this point was to gamble on an opinion. To enter at the pivotal point was to act on the market's own confirmed evidence. This required a level of patience that few possess, but it was the key to being right from the very start. His own disastrous experience with cotton, where he lost a small fortune by jumping in 5 times before the market was ready, burned this lesson into his soul. He had been correct in his analysis that a great bull move was coming, but he had been disastrously wrong in his timing. His impatience cost him the $1-million move he had so clearly foreseen. From that point on, he made it an ironclad rule to wait for the psychological moment, to let the market reach his predetermined price before he would commit a single dollar. The seventh golden rule was the foundation of his longevity, the principle that allowed him to survive the inevitable losing streaks and market panics that wiped out so many of his contemporaries. He would manage his capital with the utmost seriousness. He knew that a speculator's capital was his lifeline, his ammunition, his very means of conducting business. To risk it recklessly on a single trade, no matter how certain it seemed, was an act of business suicide. He was not in the game to be a hero for a day. He was in it to be a king for a career. This meant never betting too big. He understood the brutal mathematics of ruin. A single large loss can require a series of impossibly large wins just to get back to even. Therefore, he would only ever risk a small, manageable fraction of his total capital on any single idea. He used the famous story of the nervous cotton trader who couldn't sleep, whose friend advised him to sell down to the sleeping point. This was more than a clever anecdote. It was a profound piece of wisdom. A speculator who cannot think clearly and dispassionately because he is worried about the size of his position is a speculator who is guaranteed to lose. Livermore also practiced the discipline of securing his winnings. After a successful and substantial deal, he made it a habit to take half of his profits and lock them away in a safe deposit box. He knew the seductive danger of easy money, how it can lead to carelessness and a loss of balance. By physically converting his paper profits into real, tangible cash and putting it out of reach, he protected himself from his own potential for future recklessness. It was a mechanical defense against the human tendency to give back what the market has given. The eighth golden rule was perhaps the most difficult of all, for it required the mastery not of the market but of oneself. Control your emotions. Livermore stated unequivocally that the speculator's chief enemies are always boring from within. These enemies were not the bare syndicates or the inside pools. They were the two most powerful and primal of all human emotions, hope and fear. He knew that in the market, these two instincts are almost always inverted to the trader's detriment. The average man, when in a losing trade, is filled with hope. He hopes the market will turn, that his stock will come back. This hope, Livermore knew, is a poison. It keeps a man locked in a losing position long past the point of rational return. Conversely, when the average man has a profit, he is filled with fear. He fears the profit will vanish, and so he snatches it too quickly, cutting short a potentially great move. This fear cheats him out of the big money. Livermore's great psychological secret was that he consciously and deliberately inverted these two emotions. He forced himself to fear when he was losing and to hope when he was winning. When a trade went against him, he became fearful that the small loss could become a catastrophic one, and this fear drove him to cut it immediately. When a trade went in his favor, he became hopeful that this was the start of a major trend, and this hope gave him the courage to sit tight and let his profits run. This rewiring of his own natural impulses was the source of his legendary poise and discipline. The ninth golden rule was a principle of strategic focus. Follow the leaders. Livermore knew that it was a mistake to try and trade the entire market. He stated, "It is much easier to watch a few than many." To spread oneself too thin was to invite confusion and dilute one's analytical power. He believed that the real money was always made in the leading, active issues. If you cannot make money out of the leading active issues, he asserted, you are not going to make money out of the stock market as a whole. This meant focusing his attention on the strongest stocks in the strongest industry groups. In a bull market, he would identify the group that was leading the advance, and then he would concentrate his operations on the most powerful stock within that group. He learned to beware of the laggards. The amateur is often tempted to buy a stock that has not moved, believing it is cheaper and due for a rise. Livermore saw this as a fatal error. A stock that refuses to follow its group leader in a strong market is a stock that is advertising its own profound weakness. His trade in Chester Motors was a classic example. While the entire automobile group was soaring in a bull market, Chester stubbornly refused to advance. The public, seeing it as a bargain, began to buy. Livermore, reading the tape, saw this not as an opportunity but as a grave warning. The fact that the stock could not rally despite the bullish conditions in the public buying was a clear sign of disguised inside selling. He did not ask why. The tape's action was all the reason he needed. He sold the stock short and profited handsomely when its internal weakness was finally revealed to all. The 10th and final golden rule was a powerful injunction against the most seductive of all market temptations. Beware of inside information. Throughout his career, Livermore was bombarded with tips, rumors, and supposedly secret information from men who claimed to be in the know. He learned, through costly experience, that acting on such information was one of the quickest and most certain paths to ruin. He came to a profound conclusion. The tape is the ultimate authority, and its verdict must be trusted above all other sources. He understood the insider's dilemma perfectly. An insider might tell you when to buy a stock. He might even be sincere. But he cannot and will not tell you when to sell. To do so would be an act of treason against his own associates and his own financial interests. Therefore, the trader who acts on a tip is placing himself in a position of utter dependency, a man who has been led into a theater but has not been told where the exits are. Livermore came to trust the action of the market itself so completely that he would often trade in direct opposition to what he was being told by supposedly well-informed sources. He knew that if there was genuine inside buying, it would be reflected in the price action on the tape. If the tape did not confirm the tip, then the tip was worthless, or worse, a deliberate deception. He famously advised that every speculator should write on the first page of his notebook, in indelible ink, the words, "Beware of inside information. All inside information." These 10 rules taken together form a complete and coherent philosophy of speculation. They are a system of thought and action designed to protect the speculator from the market's dangers and from his own worst enemy, himself. They are not a guarantee of profit, for speculation can never be made entirely safe. But they are a guarantee of survival. They provide the discipline, the framework, and the psychological fortitude required to stay in the game long enough to capitalize on the great fortune-making trends. This was the ultimate legacy of Jesse Livermore, a set of golden rules that remain as true and as essential today as they were a century ago.